taxes section. And this should be fun because this is where we kind of skirt around taxes as one of the benefits to doing these types of policies. Of course, you shouldn't be getting legal or tax advice from any of us. This is all just for your infotainment to talk to other people and learn the whole story. But yeah, like right now, the way things are set up in IRS land is when you have your money in these policies, the dividend rate, it doesn't get taxed. And whether that's right or wrong, that's just how it is. Now, back in the day, people would stuff a whole bunch of money in these policies because they would get that tax treatment. That's messed up, right, guys? Smart. All of you probably would have done it. But the government got involved. It's like, wait a minute, guys. You guys can only stuff a certain amount into these policies to get the tax treatment. They wanted to limit it. And I think that's fair, right? This reminds me very similarly of the real estate professional status. When that first thing came, now all these doctors were getting this one stupid rental property and now able to use all their passive losses to lower the ordinary income, saving hundreds of thousands of dollars each. Today, now there's the whole 2,000 hour, 750 hour rule to get rep status. And similarly here, back in the day, again, you could stuff a whole bunch of money in here and have it grow tax-free. Government got involved and put some restrictions in here. But Tyler, why don't you explain like Mech, what is Mech, all these PUA, like what are all these terms that we're going to be talking about?
Sure. For this IRS Mech limit, as Lane mentioned, back in the day, people were utilizing it as an investment. So then the IRS looked at it and said, you can't put $1 for insurance and drop in $1 million in what you call PUA or paid up additions, which is really goes to boost up your cash value. The limit the IRS put on, it's basically a 3-way limit. It's based on your age and gender, and then that the policy still needs to look like it's an insurance product. So it requires some sort of a death benefit, which then requires, in order to get that death benefit, it requires some amount of premium payment for that death benefit. So there's a correlation to that. If you exceed that amount, then it becomes a modified endowment contract. It no longer is treated as an insurance product for tax purposes and gets treated more like an investment product. So you lose the tax benefits that the insurance companies have for that. The way we're playing around with this limit, because we're trying to draw down the premiums as low as possible, which also drives down the death benefit as low as possible. But we still want to be able to stuff in as much money as possible in that PUA or the paid up additions portion. So we do need some level of death benefit in order to be able to keep paying in, say, 50,000, but keeping your premium at a lowest range of about 10% of the 50,000, so 5,000. It's really just a numbers game to maximize your target amount by keeping the expenses the lowest.
What Tyler just told you there, don't worry if it went over your head. I just realized that till 6 months ago, personally. And for the most part, your agent keeps you within the fairway for this stuff. That's where I learned more about the Mech limit and things like that, and maximizing that type of stuff.
Yeah, and this IRS Mech limit, it is something you do not want to exceed it. There are times maybe in your policy life or for different purposes that people do a Mech because they want to just stuff money in there and they'll be okay with the tax implications. But for the most part, this is something that you don't want to mess with. The insurance companies know that, and they make it very difficult for you to mistakenly go over a Mech. There's all these alarms, questions asked if you're paying too much and you're about to Mech your policy. Some people may hear Mech, or they may also hear a different term of 7-year pay. It's really that limit. They're looking at a 7-year window, and the policy needs to meet those requirements for 7 years. So that's why you can't really just put a lump sum right up the bat. It won't work. It really looks at funding it for 7 years, and that's the terms you have to meet.
And not just funding it for 7 years, it can be slightly flexible. Some people stuff it in 5 to 6 years. Some people will smooth it out over 10, 20 years. I personally prefer shorter time commitments and layering multiple policies on top of each other. So you get a 5-year one, and then maybe in a couple of years, you do another 5-year one. Just layer these things on top of each other is the method, that strategy I think works best for me and most of you guys. But however you guys want to do it, that's where we can help.
Yeah, and other taxable events would be, so where the way you're accessing the cash is you're really taking a policy loan. That's how you're keeping your funds tax free. There are other events that can cause you to have to pay taxes. Say you were to just cancel the policy and you just take out the cash. If you withdraw the funds also, you'll have to pay taxes. And then this is above and beyond your premium payment. So I would look at it as it behaves as a Roth to a certain point where all the premium payments you'd be able to take out. But beyond that, any of the gains, you would have to start paying capital gains if it's met or if you withdraw the money.
Yeah, we have about 20% of the participants who already have a policy and looking for some cool advanced tips. What I would say, like, you probably missed it, but as Tyler said earlier in this chapter, there are some people in the mastermind really maximizing that contribution amount up to or over that Mech limit. That's some people will do. We'll also talk about like different places to get a third party loan. That's another little advanced trick. It's not necessary. I think the whole point is just, again, stuffing cash into this policy, investing it elsewhere while it's tax free, as we mentioned in this chapter.
Yeah, and the bottom bullet is mainly, the companies make it very hard for you to mistakenly Mech it. They also, most of them give you a window to reverse it. They'll just refund. Some of them won't even allow you to pay it online by mistake. So they'll just automatically refund the money up to the Mech limit.